All right, and now we're going to be joined by Peter Cardillo, who's the Chief Market Economist at Spartan Capital Securities. Good morning, Peter.
Good morning to you.
Thanks for joining us. A couple of questions. Obviously, this emergency rate cut by the Fed. Let's begin with firstly, did you foresee this, or does it come as a surprise to you?
No, it was a surprise to me because I expected them to cut, but I thought that they would not cut with an emergency move, and that it would have taken place, obviously, later in the month on the 17th, 18th at the FMOC meeting. And I think that, they basically sent the wrong message to the markets. And as you can see, the market certainly didn't react on the positive side. And the reason being is that it seems now that the Fed is beginning to panic. And all of a sudden, they're concerned of the virus effect on the economy, and which is a very valid reason. But by the same time, I think that they could have waited a bit more, waited until the meeting, and then make a decision. And cutting by 50 basis points, I think, is another reason to think that the Fed pushed the panic button. If they would have waited until the meeting, they could have cut by 25 basis point, and then wait and see how the macro news began to unfold, especially from China. So I think this means that that they could be pretty close to running out of ammunition.
All right, Peter, thanks for that. And now let's also bring on Seth Freeman, who's the Senior Managing Director at Glassratner Advisory and Capital. Thanks for joining in, Seth.
Yes, good morning.
Good morning. So, obviously this Fed rate cut comes as a real surprise to a lot of people. And if you also look at the way the markets responded, much to contrary opinion, they actually tanked post the announcement. So what's your take on that? How are people reading into this?
Well, following up on the comments from your last speaker, it was an abrupt rate reduction, and a much bigger increment than I would have expected. If they were going to act so quickly, 25 basis points would have been maybe a more moderate signal that the Fed is concerned, but not panicking, as the gentleman suggested. And so I actually think maybe this 50 basis point reduction signals to the market that the Fed has data, right? The Fed has a real telescope into what's going on, and that this might have encouraged a sense of panic in the market.
So then, Peter, coming back to you, in the near term, then what are we looking at for the U.S. indices? Has this, announcement by the Fed now triggered off a long-term fall because they all seem to rebound pretty well, or do you see that this is the beginning of a, maybe downturn for the U.S. markets?
Well, just look at what happened in the bond market. Look at the yields today. The 10-year went under 1%. That suggests that the bond market is pricing in even further cuts, and possibly maybe using other tools such as quantitative easing. And of course, that would be quite dangerous because the Fed's balance sheet, is still pretty much at high levels. And so adding on to that would be, I think, a long-term negative in terms of market movements. And so unless, they find out over the next 5 or 6 weeks that perhaps the coronavirus is not taking such a big bite out of economic activity, and they could pull back that 0.5% rate point decline, then maybe you can start to see confidence build in the market. But as long as the Fed has pushed this panic button, then I think it's going to be challenging for the equity markets. You can't expect investors to feel at ease when you have a Fed that's made a left turn here.
Hear you there. And we have one question for both of you. We're sitting here in India trying to make sense of what this means for emerging market economies and what signal does it really send to the rest of the globe, because America is obviously the world's largest and most advanced economy. So from both of you, one by one, Seth, if we could come to you first, what do you think this signals for Asian equities and then emerging markets?
Well, I think it's generally negative for emerging markets, just because of the stereotypical uncertainty that this environment is in, and investors certainly aren't going to add to emerging markets under these conditions. In regard to Asian equities, and I say this frequently, the growth of index funds and index-based portfolios causes a lot of damage if investors are really bailing out because of a specific country exposure like China. If it's an index fund that has other Asian countries in it and they want to get out of China, it's going to push down the markets of these other countries in the same trade. So that's one of the risks, in those markets. So on the positive side, frankly, yields in the U.S. are dropping, right? So if long-term or professional investors may see an opportunity to get higher yields in emerging markets during this time of low yield environment here.
Seth, and Peter, the same question for you really. Do you concur with Seth broadly, or do you have a different take on things?
Well, look, you just have to realize that when the world's biggest economy is in a panic mode, you can rest assured that the rest of the markets, that the rest of the countries are going to feel panicky, and we're going to see that in declining equities, I think, on a global scale. Of course, your guest has a very valid point when he says that interest rates coming down here in the States might attract some money in emerging markets that are offering higher rates of return. But again, that risk factor, I think, is a negative. And so what I think people will be looking at is typical hedges. And the best hedge that is around in the marketplace today is gold. And we saw that yesterday when gold really moved higher by over 3%. And in overnight markets, it looks as though it's moving even higher now. So I would kind of think that people would want to get into a safety investment as opposed to a risky investment, in the sense that you get higher returns and yields. But if the world's largest economy is headed for trouble, it's very difficult not to think that the emerging markets are not going to fall along the wayside.
Thanks to both of you, gentlemen, for joining us this morning, and it was really great to get your insights on the Fed rate cut.